Welcome to Talk Tickers. So Burlington Stores just reported their Q3 earnings, and get this, they raised their guidance for the whole year, and then the stock got absolutely hammered. This is one of those weird reports where the headlines are telling you one thing, but the stock chart is screaming something completely different. We're going to figure out exactly why.
Yeah, you're seeing that right. Down over 12% in a single day. That was the market's verdict. It's just a brutal reaction. And it seems to make zero sense for a company that's telling everyone their profits are going to be better than they thought. So the big question for us today is, what on earth happened here?
All right, so here's how we're going to break it all down. First, we'll look at the numbers and see why the results were so mixed. Then, we'll dig into management strategy, this profit over growth idea. We'll check out their long-term game plan and then pivot to why the market hated it so much before we make our own prediction on what's next for the stock.
Okay, let's get right into it. What was actually in this earnings report that caused such a massive sell-off? Well, the numbers were a classic case of good news, bad news, which pulled investors in totally opposite directions. So here's the scoreboard. On the bottom line, profits, it was a great quarter. Adjusted earnings per share came in at $1.80. That's up 16% from last year and way ahead of what Wall Street was expecting. But the top line, the sales figures, told a completely different story. Revenue just missed, but the really big deal was comparable store sales, a measly 1% growth, when everyone was looking for something closer to 2.5%. That's a huge miss.
And this, right here, is the central conflict of the quarter. How can a company post such a big earnings beat when its most important growth metric, people actually buying more stuff at existing stores, is so weak? For the market, that disconnect was a massive red flag.
So let's unpack management's strategy to see how this actually happened. They basically said it was partly bad luck, with the weather, but it was also the result of some very, very deliberate choices they made.
So management's number one explanation was the weather. The CEO, Michael O'Sullivan, came right out and said it. A lot of people still think of them as the old Burlington Coat Factory, which means when it's unseasonably warm, like it was in September, people just don't go shopping for coats. And that really hurts traffic and sales of their big-ticket items.
But it was not just the weather. They also took some really specific steps to protect their profits. They knew tariffs were a problem, so they intentionally bought less inventory and refused to do big markdowns. Now, those moves were great for profitability, but they came at a cost. It hurt sales and foot traffic. It was a clear, conscious choice. We're going to focus on profit over growth this quarter.
Now, you'd think with a soft sales quarter like that, management would sound pretty cautious looking ahead, right? Wrong. They came out with a very confident, very bullish picture of where this business is going, both this year and in the long run.
I mean, look at this. They didn't just meet expectations, they raised them. They took that Q3 earnings beat and told investors the whole year is going to be even better. They significantly boosted their forecast for both profit margins and earnings per share. That is a huge signal of confidence in their strategy. And they're not just sitting back. They're actually accelerating their plans to open new stores in 2026, targeting over 110 new spots. And get this, they're even opportunistically grabbing 45 leases from the bankrupt retailer Joann. That shows you they're playing offense here.
So the key takeaway here is that management sees Q3 as just a speed bump. They came out and reaffirmed their big, hairy, audacious goal of hitting $1.6 billion in operating income by 2028. In their minds, the path is clear. Expand margins, open a ton of stores, and just let the earnings growth roll in.
Okay, so if management is so confident, why did the stock get absolutely demolished? Well, this brings us back to the market's message. Investors heard that same earnings call, but they came away with a radically different conclusion.
So what does this number mean? On the day of earnings, trading volume in the stock was almost 6 times its normal daily average. When you see a spike like that, it means one thing: heavy institutional selling. The big money managers were heading for the exits, and that's the kind of pressure that just crushes a stock price.
And to put it in perspective, this wasn't just a bad day for the market. Burlington plummeted while both the broader retail sector and the S&P 500 were actually up. This tells you the sell-off was a verdict on Burlington's story, not some wider panic.
So ultimately, the market sent a really clear message. It doesn't trust the quality of an earnings beat when it comes with weak sales. Wall Street saw that weather excuse not as a one-time thing, but as a real structural risk. And it basically chose to completely ignore management's bullish guidance and focus on the weakness they saw right here, right now. So this all brings us to our final section, the next call. Where does the stock go from here? And what's the actual trade?
This is really the key question for anyone looking at this stock right now. Was that huge drop a massive overreaction and a fantastic buying opportunity? Or was it a sign of deeper problems that the market was right to punish?
So you've got two clear sides here. The bull case is pretty simple. Hey, the profit story is real, the long-term plan is still on track, and the stock is now 12% cheaper. What a deal. But the bear case is all about the risks. Sales are lagging behind their competitors, that weather sensitivity is a real problem, and now they have to manage a huge increase in inventory. That's a lot of uncertainty.
For Q4, here's our call. We think comps will land right in the middle of their guidance, at about 1.5%. We're assuming cooler weather gives them a bit of a tailwind. And on profits, we see them hitting the high end of their EPS range at $4.65, as that margin discipline keeps paying off.
So what's that mean for the stock price? Honestly, we expect it to be stuck in a trading range for a while. The bulls who believe in that long-term story will probably step in and buy around 220, but the bears who are worried about sales growth are going to keep selling anytime it gets near 260. It's going to be a tug-of-war until the company can prove it's really growing again.
And that brings us to our final rating, market perform. The long-term strategy, it's compelling, but these near-term risks and the shaky sales numbers are just too big to ignore. The risk and the reward feel pretty balanced right now, which makes it tough to have a strong conviction to either buy or sell. This is not financial advice.